Adjusting journal entries. Under the accrual basis of accounting, adjusting journal entries must be made at the end of the accounting period. Adjusting entries are made in the general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded for a business. These adjustments are made because sometimes the exchange of cash does not align with the earning of the revenue or the incurring of the expense. An important thing to note is that cash is never involved in the adjusting entry. If cash appears in the journal entry, then it is the original transaction. This is because the cash has been exchanged prior to the adjusting entry or it will be exchanged in the future. There are 4 major circumstances that require adjusting journal entries: deferred revenue, accrued revenue, deferred expense, and accrued expense. Today I will go through deferred revenues and accrued revenues. When cash is received before revenue is earned by a business, it is known as deferred revenue. An example of this is a subscription for an online streaming service. For the streaming service Zeaiter, subscribers pay a fee in order to access the streaming service for the following year. On April 1st, a customer pays Zeaiter $120 cash for a 12-month subscription to their streaming service. Because at the time of payment, the streaming service has not yet been provided to the subscriber, Zeaiter have an obligation to the customer to deliver their service. To record the transaction for receiving the $120, Zeaiter would debit their cash account and credit their unearned subscription revenue account. On the 30th of April, Zeaiter have provided 1 month of their streaming service to the customer and have consequently earned 1 month of revenue. To show that Zeaiter has provided a portion of their service to the customer, an adjusting entry must be made. To adjust their journal entries for the 1 month of revenue earned, Zeaiter debits their unearned subscription revenue account and credits their subscription revenue account by an amount of $10. This adjusting entry records the portion of Zeaiter's revenue that has now been earned from providing their service. When cash is received after revenue is earned by a business, it is known as accrued revenue. An example of this is a hairdresser's salon. On July 27th, a customer goes to get a haircut at Kathy's Cuts for $20. The customer is billed and payment is made on the 1st of August. Because Kathy's Cuts has provided a haircut to the customer before receiving payment, the customer has an obligation to Kathy's Cuts to pay for their haircut. The accrual basis of accounting requires revenue to be recorded in the period it is earned. So, at the end of the month, Kathy's Cuts debits their accounts receivable and credits their service revenue accounts by the cost of the haircut, which is $20. This journal entry shows that Kathy's Cuts has provided their service and is awaiting payment from the customer. When the customer pays for the haircut on the 1st of August, Kathy's Cuts debits their cash account and credits their accounts receivable by $20. This journal entry reflects Kathy's Cuts' collection of the receivable for their service. Thanks for watching.